Expert warns stock market crash could come in a matter of days. That's the one we're reacting to here today on the Reaction Channel, folks. Hope you enjoy this. As always, I just want to jump straight into this. 24,000 and maybe 200 subscribers now at this point in time. Just keeps going up. I appreciate every single person that subscribed. Let's jump straight into this.
Powell back on Capitol Hill today for day 2 of his testimony. He will be in front of the House Financial Services Committee this morning. Stocks tumbled yesterday after his comments that rates may have to go higher to rein in inflation. Watch this.
The latest economic data have come in stronger than expected. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes.
Joining me now is the Bear Traps Report founder and New York Times bestselling author, Larry McDonald. Larry, it's great to see you. Thanks so much for being here. I want to get your take on Jay Powell yesterday. What did you make of the speech?
Well, it's kind of like he's overcooking the goose. They're playing catch up. And while they were doing quantitative easing in 2021, inflation started to rage, and now they're trying to catch up. Our 21 Lehman systemic risk indicators that look at equity and credit point to one of the highest probabilities of a crash in the stock market looking out 60 days.
Wow. 60 days? You're saying you're going to see it? We're going to see a crash in the stock market within 60 days?
Yes, because the withdrawal of capital from the middle class families is so spectacular. For every 1% increase. Now, a lot of these economists and Wall Street people, they throw around, the Fed's hiking 100 basis points, 50 basis points. The bottom line is for every 1% increase in rates, and we've done almost 5% now, every 1% takes $50 billion out of the pockets of middle class families. Auto loans right now are approaching 14%. Almost 20% of auto loans are $1,000 a month. And so the middle class families are getting hammered here. And so the consumer pressure is, violent. But on the high end, the wealthy are doing well with excess savings and higher interest rates.
Yeah. Well, look, I'm glad you.
Okay. Wait a minute, sir. Wait just a minute, okay? He's talking about the wealthy's doing well. Okay. All right. One question, sir. Who owns all the stocks? Who owns all the stocks? You think it's the people that are struggling out there, or you think it's the wealthy? So in order to get a stock market crash, you need the wealthy to dump stocks en masse, okay? That's certainly a possibility. But you just said the wealthy's doing well, right? So, I think that's just like a total point he missed there. I mean, I would be much more concerned if, let's say the middle class was the one that controlled all the stock market and where all the money went and things like that. But that's not the situation. It's the big fund managers.
Rates, because we're talking about the 2-year above 5% today. Mortgage rates just out moments ago, the 30-year fixed rate up again now to 6.79% last week. I mean, Larry, the last time we saw mortgage rates shoot up this way, we saw real demand destruction. People were walking away from their mortgages. A new Fannie Mae survey finds Americans are pessimistic about their personal financial outlook. 31% of Americans said that they expect their personal finances to improve over the next year. But that's the lowest reading since 2010. Larry, before you get into what we're looking at in terms of rates and the impact, I want to bring Adam Johnson in here because he's on the other side of this trade. Adam, you're not expecting a recession. Lowest reading since 2010.
I'll be honest, I'm surprised those numbers aren't worse, to be quite frank. Coming off of just a brutal year for consumers out there, coming off a brutal year like that, I think that's actually fairly optimistic. Coming off of what we just came off with inflation hitting Americans the hardest we've seen since the 1970s. I actually think that's Americans being optimistic. But as a group, we're usually optimistic. Let's just put it that way. We wouldn't have got to this place without being optimistic. Believe that.
And Larry, before you get into what we're looking at in terms of rates and the impact, I want to bring Adam Johnson in here because he's on the other side of this trade. Adam, you're not expecting a recession.
No, I'm not expecting a recession. And my argument is the 2 E's of earnings and employment. Employment's at an all-time high, and earnings, while not stunning, are better than feared, and revenues are actually rising 5%. Larry, I'm curious, you made the comment that there's some sort of pending crash coming up in 60 days. That's a pretty bold statement.
Days. That's what he's getting from his Lehman indicators. He talks to so many institutions every day. Go ahead.
But I mean, 60 days, Larry. I mean, do you really believe that your indicators are right, and that there's some sort of crash when you have the most amount of people ever making the most amount of money ever, spending the most amount of money ever, and it's translating into earnings that, while not stellar, are enabling revenues to actually rise?
Go ahead, Larry.
Well, remember, if you have $10 million in the stock market 2 years ago, you're flat. Okay? So there's a lot of people that have had money in the market for a long time, all these failed rallies. That's beating on the psychology of investors, number one. Number two, $10 million in cash today generates $510,000 a year in treasuries, in one year treasuries.
Wow.
Okay, think about that. A year ago, you're talking, this was $70,000. We have to do the math here, okay? Common sense. So you're even in the market. You've been in the market for 2 years in these moronic FANG stocks that have gone nowhere, right? The most crowded trade on earth. You're flat to down after 2 years. And now you're looking over at a money market fund or a...
He just called the best companies in the world moronic. Yeah, Fox Business is different.
1 year treasury, and you get $510,000 of interest risk-free, when a year ago you were getting 70.
All right. In other words, what you're saying, Larry, if I'm hearing you right, I'll let you run with this, is that effectively that the average investor is smart enough to recognize there's now a choice between stocks and bonds. So that average investor is going to say, I'm going to sell my stocks and I'm going to go buy bonds and just make 5%. Is that basically where you're getting the notion?
Yeah, that's exactly what he's saying. There's real competition now to stocks. If I'm going to make $500,000 in fixed income, what the hell am I, dithering around?
Why does Maria gotta start yelling like that? Like, chill out, lady. I don't know why she does that. Calm down. Holy smokes. 7 in the morning. Let's just chill for a moment here.
In the stock market, if in fact I'm worried about a profits recession. Is that right, Larry?
Maria, let me ask you a question. Maria, Elaine Gazzarelli in the 80s, right? And you were probably too young for this, right?
I remember Elaine Gazzarelli. No, I remember. She was a real long-time bull.
Well, she was a long-time bull, but you know what flipped her is her model. She had this risk-free model versus equities, and it made her so famous because in the summer of 2007, the risk-free rate went up so much, she flipped to bearish because of that risk-free rate threat to equities. I'm seeing a similar dynamic now. An incredible stat is 2s, 10s are 100 basis points inverted. So that means the 2-year treasury is 100 basis points more than 10s. That's threatening. But then on top of that, you look at the underperformance of the regional banks. So your regional banks are your classic canary in the coal mine. They're underperforming the S&P by like 6, 7, 8% over the last 6, 9 months, a year. So the regional banks are telling you something really bad is happening under the surface in commercial real estate, auto loans, residential. There's really massive cracks under the surface. And that's why the market probably goes down 10, 20%, maybe 30% the next 60 days. 10,
20, 30% in the next 60 days. What do you...
So, in terms of prediction, do I think this is possible? And then we'll hear him out some more here, okay? I'll say this about his prediction here, that we're going to see a crash within 60 days. It's always a possibility, right? But the thing about making a prediction like that is it's kind of a beautiful thing, because if he's right, he's going to be seen as a genius. And the guy that called it, remember when I went on Fox Business, I told you guys we were crashing within 60 days, and it happened, right? And that's going to be like a legendary call. And if he gets it wrong, no one's going to remember. No one's going to remember. Like, it's just like we won't even, I don't even remember his name right now. What is it, McDonald? McDonald? Yeah, McDonald. So, it's kind of a genius call on his part, because if it happens, he's a genius. And if it doesn't happen, no one's going to remember, or he's going to say, oh, it's just, the Fed's being dumb or something like that. And so in order to get a crash like that, you're going to need to see, obviously, inflation numbers continue to come in very, very hot over the next couple months, which would give the sign that the Fed's going to have to raise much more aggressively than everybody anticipated, and that last month wasn't just a one-off. And in that sort of scenario, which is not super likely, but in that scenario, yeah, you would see the S&P 500 fall 10 to 20% in that scenario. But you have to have inflation come in really, really hot. And if that happened, sure, because then everybody's going to be like, oh my gosh, the Fed's going to have to raise to 7, 8, who knows? Everybody's just going to start throwing out numbers, and everybody will start freaking out, which means ultimately stocks lower in the short term. His point around treasuries and people putting money into treasuries, That's short term, absolutely. I've been talking about that recently. It's something that's hurting stocks in the short term, because a lot of people are saying, well, I'll just put my money in treasuries for now because I can get 5% or whatever on them, right? But long term, that's obviously a huge benefit for the market, because all these people are making easy, risk-free money over here that ultimately, when rates are, I can tell you, you're not going to be getting 5% plus on treasuries forever. Eventually, that's going to go away, and guess what's going to have to happen? That money's going to have to funnel back to the stock market. So long term, it's actually a great thing for the market, because people are making easy money over there right now, risk-free essentially, right? And they're going to be able to bring that money back over the stock market whenever rates start to go down.
And what do you say about the jobs picture? We've got the February jobs report out on Friday. We're waiting on ADP. It's going to be out in 30 minutes time. We'll see what the ADP numbers show in 30 minutes. But for the jobs number, we're expecting 203,000 jobs added to the economy, Larry. We're expecting the unemployment rate to hold steady at 3.4%. The ADP report, which is out in 30 minutes, is also expecting job growth of 200,000 private sector jobs. So how do you have a recession? How do you have a stock market sell-off, a crash, when we get this kind of job growth?
Well, if you look back at 2000, right, the biggest number in jobs right before the 2000 drawdown, 2001, the strongest number in the previous year and a half was literally right before the market buckled. And one of the weird things is, and Adam's alluding to this, and I can see what Adam's making a good point, jobs are strong. But if you look at, when I talk to behind me, we run an institutional chat with about 650 investors around the world. And one of the things they're talking about is when you have this January number that was so spectacular, it's gotten a lot of people excited about a soft landing. But if you look back the last 20, 30 years, when you have this seasonal adjustment in January, typically the February, when you have that spectacular kind of outperformance, which is seasonal, typically there's a mean reversion in February and March. And that's why you probably get some nice move down in jobs, which will actually help the Fed a little bit. If unemployment goes up, it'll give the Fed a little breathing room, right? So that may in some ways help. But in that case, you want to be long gold miners and things that will benefit emerging market equities, things that will benefit from the Fed cutting rates.
Well, I will say Stephanie Pomboy has been calling for this for a while. But real quick, Larry, based on all of your research and your conversations with all those institutions, where do you hide away from gold? Is that it? I mean, gold is a hedge. You say buy the gold miners in the stock market. Are there any other...
Every time is one of these doomsday guys, man. Every time, it never fails. It's gold, it's gold, it's gold, it's gold. It's every time, it never fails.
Is to hide within the stock market if, in fact, these predictions are right, that we're going to see a stock market crash within 60 days?
Okay, one of the things we're looking at is from 2001 to 2003, 4, I was on the Lehman trading floor in that period. And when you went around the trading floor after the dot-com crash, the most popular investment was European global equities. And if you look at a chart, Adam can pull this up for you later, but if you look at a chart of the global equities ex-US, okay, global equities, ex-United States versus the NASDAQ or versus the S&P, you're breaking a multi-year down channel. You're talking about 10, 15 years of massive outperformance from the United States. Now, for the first time, you're seeing spectacular outperformance from global equities, MSCI ex-US, which we would say. That is where the outperformance is going to be.
Well, I mean, look, okay. What you're saying is that U.S. stocks sell off and Europe doesn't. I have a hard time believing that in fact, if the U.S. sells off, we get a stock market crash, the rest of the world doesn't follow. And that MSCI index is loaded with Chinese stocks. So there's that.
Thank you, Maria. Great point. Great point. And that's the thing that frustrates me about a lot of bears is they have these unrealistic, the stock market's going to crash, but oil stocks are going to do great. And it's what are we talking about here? That's not the way this works. And these commodities are going to do great. And it's no, if we have a crash, commodities are going to crash too. You do realize that, right? That's not the way this works. So I love the point Maria's making here. These sorts of stocks are going to do well when the rest of the stocks are crashing.
As well, the China threat.
Yes, the EWU, well, first of all, you're 100% right. In the initial drawdown, the European equities will underperform with the U.S., but they'll outperform the U.S. over the next 2 years.
Okay.
The EWU portfolio is a golden portfolio of value global equities. EW, it's referenced as the United Kingdom, but it's a Hall of Fame basket of global value equities.
Yeah.
That's, I think, that hard asset basket, that's the basket that's going to outperform what we call financial assets in the United States, so
Okay.
growth stocks.
All right, Larry, we'll be watching. Is there a trigger for this stock market crash? Is it more inflation data? Is it more economic data that misses estimates?
The trigger will be like the S&P earnings. Everybody's expecting, the street is expecting $226.
Yeah.
That's priced for perfection. So what happens is when we deteriorate in jobs the next 2-3 months, that will bring into question the S&P earnings,
Okay.
and the S&P earnings are probably 190. So that'll trigger it.
And that's the Stephanie Pomboy narrative. That's what she's been saying on this program now. It's going to be a profits recession. Well, I guess that's what makes a market, Larry. If you're selling, it looks like Adam's going to be buying.
I am buying.
Okay.
Yeah, I am.
God bless.
That's what makes a market. Larry McDonald, it's great to see you, sir. Thanks.
So a couple things here, okay? First off, yeah, I hope that happens. I mean, that would be tremendous deals, a 10 to 30% crash within 30 days. All I'm thinking about is how much some of my hedges will be worth in that sort of scenario. Like, it'd be ridiculous if we had that fast and that rapid of a crash. Like, some of my hedges would be just crazy money, and I would take those profits and flip them into stocks at very low prices. The second part is I do wonder if this is like that year where these bears just keep getting kind of egg on their face, as they say. And, you know, if you look at last year, for instance, 2022, it was a year bulls got egg on their face, right? You know, look at Cathie Wood, look at Fundstrat, Tom Lee, right? You know, kept coming out and making these bullish calls, and the market just got worse and worse and worse and worse, right? And now a lot of these bears keep making these like crash predictions over and over again, and then like rallies happen and rallies happen. It's like, what is this coming? The crash is coming, and then they you know, I do wonder about that. I hope what he says is right. I do, because I will make crazy money on my hedges, flip those into stocks at cheap prices. But you know, I'm not going to hold my breath on that, and I'm going to consistently buy as I always buy. And there's a lot of deals out there in the market right now, and I welcome if there's any more deals. But trying to bet that for sure it's going to happen, dangerous game. There's been a lot of bears just losing their face this year, trying to make these short-term put option plays and risking their entire portfolios because, oh, the crash is coming, the crash is coming. You know, that's a dangerous thing. Like, last year was a perfect year for a crash, right? And we saw the NASDAQ go down. What was it down at the lows? Over 37% at the lows, the NASDAQ was, right? And on an intraday, 37%. And almost no one really saw that sort of damage coming, right? It was a perfect kind of scenario to just freak everybody out. This year, a lot of people are prepped for a lot of this, right? A tough year with earnings and all these things, right? The Fed has already got rates high, but they're much closer to being done as far as raising rates than the start like it was last year. So you have all these different factors, and that's why I think we're still in an ultimate market situation that's hard to get this market. You know, S&P just seems kind of stuck between 3,800 and 4,200 right now. And it seems like we're just going to move around until it's clear that we're going to have one way play out or the other. And that's that bearish scenario or the bullish scenario. And it just seems like right now we don't have enough to go off of for either scenario right now. And that's why you can't get this market to really boom. That's also why you can't get this market to crash right now. Hope you guys enjoyed today's video. As always, I appreciate everybody joining me. Thanks for being subscribed. If you want to support the channel on Patreon, that will be pinned comment down there. You also get access to my portfolio, the Patreon portfolio in there through Fidelity Investments, and seeing the stocks I'm buying and selling in there. Thank you, and have a great day.